On Wednesday morning, August 6th at 8:30 a.m. Eastern, Bob Iger, the CEO of the Walt Disney Company, is set to present the third fiscal quarter earnings report. And we'll be covering it live, of course, right here on Valiant Renegade, beginning about 30 minutes before the earnings call to go over all that Disney has to say. But the spin machine already seems to be out, and not necessarily from the usual suspects in the Hollywood media, but those from the Wall Street aficionados, the analysts, and the prognosticators of, well, stuff and things. Renegade Online. Well, folks, welcome back. Another great day here at Valiant Renegade. It's good to see all of you out there once again. And if you are like one of the many watching this video not yet subscribed to this channel, please take a moment and turn that little red subscribe button to gray. Hit that like button, hit that notification bell, share this sucker out on the social medias, and of course, please do leave a comment before you head out the door today. Make sure to join us every Sunday and Wednesday afternoon right here at 6 p.m. Eastern for the live shows and the Disney earnings call Wednesday morning at 8 a.m. Eastern. So the cacophony of obfuscation has already commenced. Morgan Stanley's Ben Swinburne, a man that, quite frankly, I have a lot of professional respect for, somebody like myself who has spent over 20 years managing a private financial planning firm. We know these guys' names. We know the analysts' names. And Ben is somebody we frequently bring up in our topics of conversation, especially when it comes around to earnings season for the entertainment industry. He's on all the calls for Disney, for Warner Brothers, for Paramount, for Universal, Comcast, on down the line. But Ben Swinburne is raising Morgan Stanley's price target for the Walt Disney Company to $140. And usually those price targets are something that are projected out over the course of 12 months. Of course, we'll have a year to see if that actually happens, but if history is any guide in the last several years, they may well miss the mark. So Ben Swinburne of Morgan Stanley, as I might add, also the same Morgan Stanley whose very own Jim Gorman of Morgan Stanley sits the board of the Walt Disney Company. As a matter of fact, he's the guy in charge of finding Bob Iger's successor. So, hey, just to throw that out there for what it's worth. Let's go here to the discussion on CNBC this week.
Joining us now to discuss all the details is the author of that note, Ben Swinburne, the head of U.S. media research at Morgan Stanley. Good to see you. So the two big questions for me are Disney Plus costs and theme park pricing. Have they got each of those things in the right balance, and that's why you think it can keep running?
Now, I want you to listen to the opening question from the anchor of CNBC, a very appropriate and poignant question. So does the Walt Disney Company have the pricing for Disney Plus and the theme parks at the right measure? Now, listen, those are, quite frankly, the two biggest things that have been driving, or should I say, slamming the brakes on the Walt Disney Company over the last several years, especially since the post-COVID recovery began, and let's call it 2021. Let's listen to Ben's answer.
Well, thanks for having me. I would say yes to both of those questions. On the cost side for Disney Plus, Disney's really been rationalizing their spending across the business over the last several years, really since Bob Iger came back as CEO.
Now, wait a minute. Okay, Disney is rationalizing costs only since Bob Iger came back. With all due respect, Ben, I've got to give you a little pushback on this one because Bob Chapek, who only had 10 months and 2 weeks to try to do anything at the Walt Disney Company while he was being sabotaged less than 30 days in to his sole chief executive officer role after Bob Iger left December 31st of 2021. I seem to remember it was Bob Chapek that began a lot of the cost-cutting measures, a lot of the cost restructuring at Disney, which, if we all go back and do a simple Google search, we'll find that Bob Iger, when he came back in late November of 2022, basically picked up the mantle that Bob Chapek had begun and then took all the credit for it.
In fact, we've had real positive earnings revisions over the last 2 years, largely driven by lower than expected costs on the streaming front. So that's in a very good spot. And then on the theme park front,
lower than expected costs on the streaming front. Let me just remind everybody out there something that I've been saying right here on this YouTube channel for damn near 4 years. Wall Street is overwhelmingly to blame for the drive into streaming. They got overexcited, the overexuberance of the success of Netflix, and thought that that could apply to everybody else out there. When I was telling you years ago, that ain't the case. It doesn't work that way. Netflix was first to the show. Netflix got the leg up on all the competition. Netflix is the only major streamer out there apart from Amazon, which is more akin to free shipping if you pay the extra costs rather than a proprietary video streaming service, that actually is a non-studio entity. It doesn't have an inherent library of content like does Paramount, Warner Brothers, or Sony, or Comcast, Universal, and yes, including Disney. Wall Street was the gang that was out there driving for growth in the almighty subscriber at the expense of quite literally everything else. And I'm kind of getting irritated at this point of the game in mid-2025, and we still have Wall Street analysts out there that actually believe the Bob Iger bullshit that it was all Chapek's fault, and that Iger was the guy that had everything running smoothly at Disney, but for the 10 months that Chapek was in there, and according to him and his cronies and his Wall Street people, well, Chapek in 10 months completely sank the world. It's a ridiculous proposition, and we've covered this 7 ways to Sunday. All of the failed Disney Plus projects were greenlit under Bob Iger, overwhelmingly. In fact, the biggest success that Disney has had in the last several years would be Deadpool and Wolverine. Who put that movie together? Who greenlit that movie? Who got Hugh Jackman and Ryan Reynolds back in the fray to put that one together? It was Bob Chapek.
The way we look at it, post-COVID, there was just a surge in consumer spending, kind of revenge travel, all the things you know about. That had to be digested, which we think happened last year. And now we look at this and it's back to kind of a normalized trend line. So we think experiences segment growth can be the big growth driver for the earnings growth of overall Disney over the next couple of years.
Yeah, experiences segment could be the biggest growth driver for Disney. Explain that to me, please. I want more clarity on this, because every piece of anecdotal, albeit anecdotal evidence that we have right now, people that have been hanging out in Disney parks all summer long have consistently been indicating that the crowd sizes at the Magic Kingdom and the other theme parks that Disney encompasses in Orlando have been light, or at worst, abysmal. It seems clear that a lot of the traffic has gravitated towards Epic Universe, Universal's new park opening this summer. And they seem to be wanting to skim over that. Even Josh D'Amaro and Bob Iger on the last earnings call talked about how it'll be fine.
So I know you own this one as well. So I got to try to push back a bit on the concept of pressure test your position here. With AI coming through, this is a big IP owner. It stands perhaps to get either taken advantage of or for the value of its assets to diminish. Why won't it?
Well, I think one of the things that has such original content that we've all grown up with generational, over time. And I think as the younger generations look at it and you kind of add to it, the cost of the goods again there is much lower than kind of creating new content for Disney.
This is the problem. Disney they've tried to create new content, and they have been almost entirely unsuccessful, if not completely unsuccessful at it in the last several years. Why wasn't the question posed in the manner that would bring up the failures at the box office, the massive, and I mean abysmal failures at the box office for the Walt Disney Company over the last several years? As a matter of fact, since theaters opened, after COVID shutdowns. The first piece was Marvel's Shang-Chi, and then the Eternals. A lot of people like to associate Spider-Man with Disney, but I keep reminding folks that while Disney obviously had a massive hand in producing the film itself, that is still a Sony-owned property, or at least through lease. Disney can't get it back. They wish they could. But Sony walked away with the overwhelming lion's share of profits from that film. Disney really hasn't had much to write home about. They're not generating any new intellectual properties that are bringing people in, that are selling tons of merchandise. This would have been the perfect opportunity to ask about the Disney failures of Disney Plus and of the theatrical slates that they have released. And those failures are measured against the enormous amount of capital expenditures that were invested in these properties. When you think about a $200 to $300 million Disney Plus television show from Marvel or Star Wars, routinely that goes on again and again and again, with exceptions to things like Agatha All Along, granted. The problem is that Disney is spending way too much money trying to create properties that nobody by comparison is watching. When your average Disney Plus Marvel show is dragging in 1/4, 1/5, 1/10 the audience of the average random piece of stuff on Netflix or virtually anywhere else, how do you keep missing this boat? The problem is that Wall Street, of course, doesn't know how the sausage is made. They just know what they're told by people like Bob Iger.
And I think combining all their streaming services and really focusing on the costs and growing kind of the streaming, I think that's going to add a lot of cash flow to a company that, during COVID had a really hard time just trying to meet they cut their dividend, et cetera. So I think that's going to be interesting.
Yeah, no secret that the Walt Disney Company has been long trying to combine Hulu, which has, quite frankly, been for many years a relative powerhouse in the streaming industry, especially when it comes to advertising, with a frankly much lesser entity like Disney Plus. But Valiant, what do you mean? Disney Plus has 100+ million subscribers. It sure does, but the average age of the viewer on Disney Plus is something like 7 or 8 years old. These are a bunch of kids being sat in front of a digital babysitter to watch Bluey and reruns of Mickey Mouse Clubhouse and other library content, things that cost Disney virtually nothing to keep on there. Well, of course, Bluey probably cost them quite a bit, maybe billions of dollars over time, but it's the only thing keeping children engaged on Disney Plus. The adult population, by and large, isn't there, and we know that factually because, quite frankly, the viewership for major $200 and $300 million Disney Plus shows from Marvel and Star Wars bring in paltry audiences that, quite frankly, would be in competition with mediocre stuff on the old CW network.
I think it's a cheap stock. There are two things that concern me. One is what are they going to do with ESPN and how are we going to monetize that? And then the other one that...
You know why it's a cheap stock? It's a cheap stock because Bob Iger has failed to really turn it into something that has more value. Bob Iger is really, really good at spending shareholder capital to buy other people's stuff that works. But then eventually, over a long enough time horizon, he has managed to break damn near every one of them. We've gone back and we've talked about this a myriad of times.
And then the other one is the succession, who is going to take over. I know they're focused on that, and James Gorman is running that for their board, but that's going to be an interesting kind of next leg for the stock because it's come back. It's, it's not cheap. I think it's fairly valued, but it can compound. And if it has earnings growth, because it's one of those stocks that I think can do really well for the next few years.
Yeah, James Gorman of Morgan Stanley, basically Ben Swinburne's boss. The other guy, not this guy. He's not Ben Swinburne. But, something else that he said here is very interesting. He said, I don't think that Disney is a cheap stock. I think right now it's fairly valued. And I'm going to applaud him for that one because I think he's right. If anything, he might be a little generous in that regard. The Walt Disney Company has had a history of a lot of stock volatility in the last 5 or 6 years. I don't know if anything is going to change in the near future. I'm not trying to give people advice on what to do with this or any other stock out there. I'm just giving you my observations over the course of time, just seeing what has happened and seeing the financial performance of Disney. And again, all of this interview that you're watching right now is designed to lead people in with a preconceived notion of what's going to happen at the earnings call on Wednesday morning.
I'd love to pick up on that point because that was exactly what I was going to ask. Bob Iger sort of has brought back some reassurance in that top seat at Disney. Who's going to replace him? It doesn't look like he's going to be there forever. And if you're an investor, what are you looking for?
Well, I'm not going to make a prediction on the next CEO right here, that's for sure. But I would say that we have tremendous confidence in the board and the succession committee. We think it's a real process.
I wonder why his boss is heading it, Jim Gorman.
And as they've announced publicly, we should hear early 2026 who the next CEO is going to be. And so I think having visibility into the timeline is actually quite helpful for the marketplace. But there's a lot of talent on the bench at Disney. And we think there's lots of good options for the company to choose from.
Is there, though? Is there really a lot of talent on the bench at Disney? I've been sticking to this point now for years that I personally don't believe that there's anybody who is currently at Disney that is capable of running this company to the point where it can actually be fixed. They keep wanting to slam Band-Aids on things, or to put it another way, they keep wanting to slam multi-billion-dollar shareholder capital investments on things to make people think that something big is coming. This will get better, we promise. And it never seems to happen. Remember the $60 billion promised of CapEx that was going to be invested in resorts and experiences and theme parks a couple of years ago? Remember, Disney had absolutely zero plan of what to do with that money by and large when they announced it. It was done to just literally get Wall Street off their ass, to give them something to get excited about. And then, of course, as time went on, people realized that, okay, well, what are we actually going to do with this? It still hasn't been fleshed out. I guess, of course, except for the fact that they've taken a bunch of red clay and concrete and poured it in to the rivers of America in the Magic Kingdom in Orlando. One of the most beautiful sections of the park is now being filled in. Yeah, they paved over Paradise and put up a parking lot for a new Cars attraction. I'm sure, without a doubt, that that's absolutely going to go toe-to-toe with Epic Universe if you're retarded.
What do you want them to do with ESPN, to Surat's point? There's been so much discussion over this and really no resolutions at this point.
Yeah, so when we pitch Disney to try to simplify things, we talk about this being a theme park company that owns media assets, where it used to be a media company that owned theme park assets. And when we add streaming...
And he's totally right about that, no question.
...and parks together, you're getting an earnings contribution 60% plus and growing. So that's really what drives the business. Of course, ESPN is important. In fact, one of the things, you mentioned...
And again, the theme park element, and it unfortunately seems to get very glossed over in this interview, and I think for obvious reasons. The theme park element is the driving force, but the problems they seem to have this summer with Epic Universe opened up are not being addressed in any way in this interview. Here comes the deflection right here. Here comes the deflection.
ESPN is important. In fact, one of the things, you mentioned the lead-in Disney Plus turning 6 years old later this year. They're going to be bringing ESPN into the Disney Plus Hulu bundle in the next couple of weeks. In fact, when they report earnings on Wednesday, I think you may hear an official date for when ESPN will be sort of set free from the bundle for the first time ever. And you may hear from them a transaction with the NFL, which has been written about in the press, with the NFL taking an equity stake in ESPN. ESPN's about 15% of the earnings. So it matters, but it doesn't matter as much as it used to. But I think having the NFL as an investor, if that's what they actually announce, and then bringing ESPN fully into Disney Plus will give ESPN the best chance it can get in thriving in the new streaming world.
Yeah, let me go ahead and push back on that as well. Again, we're shifting the conversation away from parks, back into streaming. Hey, Disney Plus isn't going to be the future. Hey, Hulu, that they spent $70 billion to buy Fox, which they have done little to nothing with since then, and which was grossly overpaid, by the way, back in 2018. And then they spent another $10 billion recently to buy out the last remaining segment of ownership of Hulu from Comcast Universal, which, by the way, that $10 billion effectively paid to have Epic Universe built right down the street from the Walt Disney World company, which is kicking their ass right now this summer. But no, ESPN is going to be the new thing for them that's going to save the day. I don't think it will be. And let me tell you why. You got to realize roughly 70% traditionally of all cable subscribers out there, they don't watch ESPN. They don't watch live sports. They're just there for the general programming. One of the reasons that ESPN's flagship streaming service is reportedly going to debut with a $30 a month price tag is because, well, frankly, that fits into the mold. If everybody canceled their cable subscription tomorrow and then turned around and only those who watched ESPN would sign up for ESPN streaming service, they would need 3 to 4 times the amount of revenue per subscriber as they did when they were receiving revenue from every cable subscriber out there, even the 60 to 70% that didn't watch ESPN. Think about this for a second. ESPN doesn't have most of the NFL, which is the crown jewel. And this is why the Walt Disney Company is now entering into this extensive contract with the NFL to do co-branding with the NFL Network, working together, adding more games to the package. Because quite honestly, Disney knows by now that the $2.5 billion or whatever per year they just committed to the NBA in their renewal contract isn't worth the paper it's printed on, because the NBA is a dying sports league. They've already started selling off certain things like college football playoff games to other networks because they're going to have to raise the revenue to make up for the gap of the NBA. And I don't think the Walt Disney Company wanted to let the NBA contract go, even though, quite frankly, they probably should have, because Bob Iger ego, Bob Iger legacy. He just couldn't bring himself to be the guy to make that decision. But Bob Iger doesn't give a shit. All he does is spend your money as Disney shareholders on really bad investments that he doesn't know what to do with once he actually signs the paper.
So, Rod, I worry about the sports landscape in that I'm not a big sports guy. I don't watch ESPN or any of that. But the sports content I see is put out by the leagues on social media.
There you go.
That's where I see it, largely. So how much margin can you expect to get as a sports presentation, sports content brand if you're not the league itself and you're, in a way, competing with or cooperating in a league that wants its own margin?
Now, look, I love this guy on CNBC. He's doing a great job. He is asking all the right questions. He is pushing back. This is a smart dude right here. God bless him.
You are, but the key is live TV, live sports. That's where the ESPNs of the world make their money, or Major League Baseball or NFL Network. It's not the replays, the sports centers. It's that live action that people will pay money for, whether it's on Hulu for ABC or that's what you're going to look for. It's not just playing, hey, this happened last year. So people are going to pay for that, and that's where ESPN is going to have to make their money. Otherwise, it's this declining asset, which you're talking about. You're not going to pay for the growth.
That's the problem. He finally brings it up at the end. It's all a smokescreen for Wednesday morning. Disney is going to deflect people from probably what is going to be a relatively soft report on theme park revenue and try to get their attention focused somewhere else. Look! Yes, Disney is going to have to talk about the theme parks, but it already seems clear to me that much of the attention is going to be deliberately engineered and deflected away from that and onto things like an NFL partnership and ESPN's launch of their flagship service. The reality is, and what Disney is not going to tell you during that call, is that somewhere in the back office, even guys like Jimmy Pitaro, who runs ESPN, is having to acknowledge the real problem they're going to have with probably what's going to be the most egregious rate of churn in the history of streaming services. At $30 to $40 a month, even if it starts at $29.99 a month, I promise you, it's going to be $40 to $50 a month within the next 5 years, maybe even less than that. The rate of churn on that service is going to be outrageous. The NFL fans will show up for a couple of months to be able to get their Monday Night Football if that's where they want to go, or the NBA fans will show up for the length of time they need for that. Hockey fans, SEC football in the fall, things like this. You're going to have a lot of people that are going to sign up for half a year and then leave. And the real problem is that people are suddenly going to realize, who actually want to watch sports, that it's going to be a lot cheaper for them to just go ahead and stay signed up for things like YouTube TV and just get all the ESPN stuff through there, as opposed to paying $30 to $40 a month just for ESPN. Because again, a lot of these cable providers right now are forcing companies like Disney, along with Peacock and Paramount and everybody else, to be in the position to where, hey, if we have people sign up for our cable service, then you have to give them access to your streaming service as part of it. And guess what? With Spectrum and Charter, ESPN Flagship was part of that deal. So those 14 million subscribers, hey, all they have to do is hang on to their Charter subscription. And guess what? It's still a much better deal than trying to sign up for a bunch of different streaming services, especially when it comes to those who want to watch live sports. So the question becomes, how big is ESPN really going to be in the long run as a standalone streaming service? I have an enormous amount of doubts. But again, it doesn't matter, because on Wednesday morning, Disney will absolutely use that to distract everyone else from the other major problems they have on Disney Plus and at the box office, and yes, I believe even at theme parks right now. Have fun. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.